Good morning, everybody. It's an honor for me to be part of this conference this morning. I will try to provide thoughts to let each of you answer the question, can sustainable investments deliver superior long-term performance? There are tons of academic papers, articles, conferences that aimed at demonstrating that factoring environmental, social, and governance criteria into investment decisions deliver superior returns. I'm not going to add any compilation of studies to show graphs with divergences between green and conventional bonds or ESG versus non-ESG equity indices performance. I will rather share with you some thoughts on how sustainability can contribute to long-term value creation. The first point that I want to make is that the investment industry is evolving very fast, especially over the last years. When I started on financial markets, it was all about return. Then investors started to point out that risk could be a driver of performance. And it had become obvious that a risk-return metric provides possible comparison, which is helpful for investment decisions. Regulators at that time have translated this risk dimension into capital charge for bank and insurance industries. And investments are measured under what is commonly called return on risk-adjusted capital. This highlights the concept of risk budget, which is also welcomed by the asset management industry. But over the last years, a third dimension has completed the landscape, pushing the analysis beyond financial factors, its sustainability. Sustainability is a twofold concept that I will discuss a little further, but I've heard that already some of the panelists have talked about this sustainability and this double materiality. Before we dig into the linkages between sustainability and long-term value creation, let me first talk about sustainability risks. It's quite simple to understand that beyond financial risks, other factors can have consequences on the value of financial assets, on the expected income of investments. These non-financial factors, usually encompassed under the ESG acronym, can be considered as early signals of future risks. Under the governance pillar, for instance, who has forgotten Tesla, Volkswagen, more recently Wirecard? Volkswagen is a very good example. The scandal has come as a tsunami for the bulk of the financial community, but some responsible investors had already exited the name based on weak governance, scoring by non-financial rating agencies or by their internal scoring processes. All investors know it. Building long-term performance often starts by avoiding worst performers. I can also, of course, take the example of climate change. Who remembers PGE? Pacific Gas and Electricity is a utility company operating in the US, which went bankrupt in 2019 because of liabilities stemming from its power lines causing Californian wildfires. It was considered at that time as the first so-called climate change bankruptcy. Fires were intensified by hot and dry conditions, and the stock has collapsed by 85%. Controversies on social matters, also strongly damaging reputation of companies, negatively impact the value of assets and increase the volatility because of uncertainties. All what investors try to avoid when investing to create long-term value, finally. Examples don't make a theory, but it's interesting to try and build upon experience. In these examples, non-financial drivers provide an additional dimension to analyze potential risks. It sounds obvious that all these events, even if not predictable, could at least have been better anticipated should investors access all relevant information to assess risks an investment is exposed to. For this, materiality is key. Let me take again an example. A domestic investor investing in its currency in a domestic company operating locally does not bear currency risk. Providing information on potential currency risk acts as a noise in the overall risk assessment process. It's the same with non-financial information that should be proportionate to the risk borne by the investee to provide meaningful information to potential investors. Incorporating sustainability criteria in investment decisions enhance the ability to build a resilient portfolio. But we need to think beyond. That's when the concept of double materiality that underpins responsible investment comes and complements the picture. It enables to consider the investment cycle in its entirety. What is double materiality? It has been highlighted by the European Commission during the revision of the non-binding guidelines. This concept defines the two sides of the coin of sustainability. The outside-in effect of sustainability on the value of assets, which we have just discussed, and the inside-out effect of investment decisions. Analyzing the impact of investment decisions on ecosystems and society is the other lens of the double materiality principle, which also contributes to long-term value creation. For those who may still be skeptical on the benefits of considering inside-out impacts of value creation, let's take a pragmatic example. I'm more than lucky to work at SCOR, which is a reinsurance company, and risk management is at the heart of our core business. We do consider climate change first as an opportunity. It's our raw material for underwriting protection against natural catastrophes. Should there be no climate risk, we would not be able to do this business. So physical climate risk is well understood in the company. It's also modeled and even priced. It's climate change that raises issues as insurability of some geographical areas may be at stake. But when we consider the impact of our investment decisions on global warming through carbon footprinting and implied temperature risk measures, for instance, we get ways to steer our investment decision to protect our long-term underwriting business. The dependency to nature is also obvious, and ecosystem services are critical to the economy as a whole. Preserving biodiversity and participating to the reversion of biodiversity loss will benefit to the development of society and the entire ecosystems. Actions to deal with the inside-out effects can take different aspects. As I said, steering the implied temperature rise of investment portfolios participate to addressing climate change. Limiting global warming protects our underwriting business over the long term. It's also a way to limit potential physical risks borne by our long-term investments, especially in real estate. The loop-back effect may be difficult to quantify, but it should not be undermined. When extending our view to longer-term horizon, it becomes obvious that we will directly or indirectly be remunerated depending on our investment preferences. Seeking for solutions to tackle climate crisis leads to new investment opportunities, and it also extends our investment universe. The momentum for green bond issuance is a wonderful testimony of how to transform a constraint into investment opportunities. COVID-19 has played an equivalent role on the social aspects. Companies paying attention to human capital have overall performed better than more traditional players, the ones who focus more on short-term metrics and financials. Some investors consider sustainable investment as a short-lived fancy. Not only it has gained momentum, but it's accelerating, onboarding more and more actors. Limiting responsible investment to including E, S, and G criteria in investment decisions would be very limitative. Stewardship and transparency also contribute to creating sustainable long-term value. Supporting the transition to a low-carbon economy, engaging with companies to ensure they respect human rights, fostering transparency throughout the entire value chain are powerful tools available to investors individually or through collaborative initiatives. Supporting companies that commit to more sustainable business models and pushing others to accelerate their transformation can have material impacts on the real economy and finally protect the value of investments. Advocating for good practices and acting through engagement to make companies and investees transition their business model to more sustainable activities is foundational to create long-term value. Early identification of best-in-class companies participates to building resilient and performing portfolios. This being said, we also need to keep in mind that trying to detect mega trends and stay ahead of the curve is one of the main objectives of portfolio managers. The direction is crystal clear and sustainable investment is on its way to become mainstream. Regulation paves the way. Think of the European Green Deal, which puts the emphasis on tackling climate change. Think about the next generation EU, which intends to accelerate the green and digital transition. The taxonomy regulation, together with the sustainable finance disclosure regulation, also intend to foster transparency. The entire regulatory landscape, at least in Europe, intends to drive flows of capital towards sustainable investments. The platform on sustainable finance contemplates the development of a social taxonomy alongside environmental objectives. It sounds odd to me. When central banks provide some guidance on interest rates, financial markets adopt their views immediately. It looks very different for sustainability, despite numerous signals sent by regulators, NGOs, civil society, rating agencies, policymakers. The momentum is there. Trillions are needed to achieve the transition, and measures taken by policymakers to shift capital flows are absolutely impressive. Now let's pause. When trying to compare responsible investment with what I could call traditional or conventional investment, of course, one focuses on performance. Performance is commonly understood as returning on financial capital. Sustainable value creation should go beyond and consider natural, human, and social capitals. Those components are not yet priced nor valued in traditional investment decisions. Starting to consider preserving natural and human capitals is the purpose of the do no significant harm concept established alongside the EU taxonomy. It provides a more holistic approach of investment based not only on financial capital, but also recognizing services from nature and societies. Those services are far from being completely identified, are not priced, and in most of the cases might never be monetized. But investors should not undermine their value. Maintaining the same performance and further limiting negative impacts on natural and human capitals is already creating superior value. As for risk-adjusted returns, which enables to compare various investments for a given budget of risk, one should account for returns on all capitals, be them negative on nature and humanity, when assessing which investment performs better. Because Earth's resources are limited, we should consider resource depletion. And to ensure peace and prosperity for all, we should factor poverty and deprivation. We need to bring back long-term impacts in today's investment decisions. Sustainability should be considered holistically. It brings awareness on the responsibility of investors in building a sustainable world. Investors are becoming mindful of what they invest in when using the double materiality lens. Sustainability raises the question of how to return not only on financial capital, but also on nature and societies. And as such, it opens the door to thinking multi-capitals, which complements traditional investments and creates new opportunities. As stated more than 30 years ago, sustainable development is development that meets the needs of the present without compromising the ability of future generations to meet their own needs. Hopefully, sustainable investment will serve sustainable development. Thanks for your attention and happy to take any question. Thank you all and have a nice day.